This meeting is being recorded.
All right, welcome back to Principles of Accounting 1. So many principles courses. Welcome to Principles of Accounting 1. I am still your host, Dr. B. Happy to have you with us as we talk about merchandising companies, and the type of adjusting entries that they make. When we talk about merchandise, we're going to be talking about it from the frame of mind of a retailer. And I'm going to give you a lot of real life examples in my retail career experience. And I'll also give you some examples of my favorite retail store, Macy's. So I'll make today as fun as humanly possible. And during today's conversation, when you go into the store next time, when you go into any retail store, I'm telling you, you're going to think about this, and you're going to be like, man, I never really thought about how the business operates from that perspective. And it'll be interesting. I promise you. I promise you. So, okay. Before we jump into the conversation on retail merchandising and the transactions involved with adjusting entries, before we jump into that, I want to call your attention to the classroom, because this is really important where we are today. We made it to week 5 already, if you can believe that or not. And I got to tell you, the time goes by so quickly, right? It goes by so quick, and it makes me nervous sometimes with how fast time goes by. The reason why it makes me nervous is because a couple of things. Most of you are doing extremely well. I just want to say up front, you're doing very, very well. And part of the reason why you're doing so well is because you're doing the work and you're doing it on time, or at least as close to on time as you can. And I want to say I really appreciate that. I think that the more that you're on time and ahead of your work in this course, or on top of your work in this course, the better your grade's going to be. I promise you this. It's just a matter of doing the work and doing it on time, and you'll do well. It's really that easy. So I appreciate all of your efforts so far, and I appreciate you being here, of course. The reason why I mentioned that we're in a pivotal time in this class is because here in week 5, we got a couple things going on, as you know. We got the discussion for our merchandising, which includes 9 questions that you need to answer. Okay, 9 questions you need to answer. So before you panic and say, Dr. B, what are you doing to me? That's a lot of work. Before you panic, think about it this way. There's 9 questions. That means there's at least 9 sentences. Okay, so if you think of it from that perspective, if you write 9 concise sentences responding to these questions, that's just simply 9 questions, 1 sentence per question. If you're concise with it, it's not that bad. It's not that bad. Okay? So think of it that way. Don't freak out. It's not that bad, I promise. 9 questions, 9 sentences. That's what I'm looking for. That will put you around that 150 word mark. Yep. And then respond to 2 of your classmates with 100 words each. Yeah. Simple paragraph response to 2 classmates. Simple, simple, simple. Okay. Most of you are doing a really good job with that, with all of our discussions, and I'd like to encourage you to continue forward doing a good job, so that way you earn the full points. Yep. And I'm not picky. I'm not going to be counting the number of words. I'm not going to do that. Okay. I don't have that kind of time or that kind of effort. But if I see it substantial enough, you get the credit. So that's my talk on the discussion. And then you have the quiz. But why is this time, week 5, so important? You might ask. Looking ahead, okay? The next 3 weeks, I'm going to be in Medellin, Colombia, the country, not the city. I'll be in Medellin, Colombia. And the reason why I'll be in Medellin, Colombia for the next 3 weeks is because I am working on a very important accounting research project with the Colombian and the American governments. So it's a very pivotal time for this course, because that means over the next 3 weeks, we're not going to be able to host our regularly scheduled lecture for all 3 weeks. We're going to try. I'm going to try to hold our class over the next 3 weeks in person here in WebEx. But there's a good chance that the timing is not going to work out well. So because of that, I wanted to plan ahead. And so for the next 3 weeks, you'll notice when you go into those respective weeks, I have posted the recorded lecture already for each of those weeks, just in case we don't have the opportunity to meet in WebEx. I'll let you know in advance, obviously. Of course, I'll still have my computer, I'll still be in the classroom every day online. But it's just, the meetings with everything that's going on with the government is going to be very chaotic. So I just wanted you to be aware that that's happening. What that means for week 8 is week 8 is the midterm, in addition to a chapter. Lucky for you, I care a lot about you. And so what that means is I posted a midterm exam review video. Okay. For some of you who have had me before for other courses like principles of macroeconomics or microeconomics, and some of you, Miss Mack, more in particular, had me before for another class over the summer. And Miss Mack knows that I like to do reviews of the exams before they happen. Okay, and so I try to record all these sessions beforehand. So it's there for you. I just wanted you to be aware of what might be happening over the next 3 weeks, is that I'm just going to be so darn busy with this project that we might not have enough time for the lectures and WebEx. So I posted the videos beforehand. But again, I'm going to try. I'm going to try to make it happen. I just wanted to let you know well in advance. So don't panic, okay? I got your back. You know that. I haven't lost a patient yet, and I don't plan on losing one this semester. So stick with me. We'll get through it. And I'm here to support you all the way. So even if, you can't get a hold of me right away, send me the email. I'll get back to you. Okay? Calling, that's going to be a little challenging since I'll be in Columbia. But you can still send me the email, and I'll give you my Skype, the WhatsApp number. Okay. So just so you know. All right. Let's jump into today's lecture, shall we? So today, we're going to talk about this concept. What the heck just happened? Got 3 monitors, so sometimes it gets a little chaotic here. Oh, it did it again. Gun. Hold on just a sec. There we go. Okay. Sometimes the third time's a charm, right? Okay, so here we go. Let's talk about this concept called adjusting entries, and we're going to do it through merchandise transactions. So I want to talk to you a lot about the merchandise business today. When we talk about merchandising, I want you to think about a retailer. And my favorite retailer, as you know, is Macy's. And I also have a career in retail in a previous life of mine. Probably at least 15 years ago. But I remember it well because I still have PTSD from that. And I'm going to talk to you about, from a retail perspective, the type of transactions that we go through. We're also going to talk about inventory from a retail perspective. Okay, so first, let me talk to you a little bit about the difference between a retailer and a service company. So it'll give you an understanding of the type of cost, revenue, and expenses are involved in each type of business. A service business is a type of business that provides a service. Examples would be accounting firms, law firms, plumbing services, lawn care services, etc. They provide a service. So a service company records their sales as service revenue. A service company records their sales as service revenue. And their income statement, it reads like this: sales or revenue minus their expenses, all their expenses are listed out, equals net income. Sales minus expenses equals net income. Very straightforward. That's a very simple income statement for a service business. When we talk about retail or a merchandise company, it gets slightly more complex, but ever so slightly. And let me show you what a retail or merchandise company income statement looks like. So here we have Nordstrom. Man, they're not doing well, are they, Nordstrom? Macy's. Here we have Macy's. Okay. There's not many big box retailers left these days. Nordstrom's doing okay. Well, they're struggling, but so is Macy's. Okay, so here we have a merchandise company, Nordstrom. And we can see their income statement format and that it is different from what we saw with the service company. And here is how it looks. We have sales, also known as net sales. The reason why a merchandise business calls it net sales instead of just sales is because retailers oftentimes offer discounts on their merchandise. For example, I went into Macy's the other day and I purchased a red t-shirt for $20. It was on sale. It normally costs $25. Okay, so $5 off. Good deal. So the net sale was $20. The gross amount was $25. The net amount is $20. So think about when you go to the register. You take the product to the register. They scan it, the barcode. They scan the barcode. And it shows on the screen $25. And then when they hit total, it says 20. Right? Because it's on sale. The net sale amount is the 20. You see? So that's why we call it net sales. It's sales minus any type of discounts. So net sales. Net sales. Going down the income statement, the next line item is called cost of goods sold. Cost of goods sold. Cost of goods sold, just as the name implies, is the cost of the goods that it costs the company to sell it to the customer. Here's what I mean. This is a real life example, y'all. And I want you to listen to some of these numbers because you're gonna be real interested. Think about clothing. I want you to think about clothing, okay? The red t-shirt from Macy's, for example. I bought the red t-shirt from Macy's on sale, $5 off. The normal we call it list price. The normal retail price was $25. I bought it on sale for $20. Okay. How much do you think, I'm asking the class, how much do you think Macy's paid for that red shirt from their distributor? How much did they buy the red shirt from their distributor? What do you think?
$2.
Oh, that's high.
Ooh. Some cents.
It's probably close. I would say
Like 75 cents.
probably about 75 cent, maybe 50 cent, 75 cent. Yeah. That's real. That's real. Now let me explain how it got to that price. Let's think about how the red shirt was made. Okay? We got a beautiful textile business manufacturer in Bangladesh or somewhere where they make decent clothing. Bangladesh, they make really good clothing. They have some of the finest threads on the planet. So Bangladesh, okay, they make the red shirt. And so how much do you think it cost to make it? If it cost Macy's, we'll say 50 cents to buy it from their distributor, how much do you think it cost to make that red shirt? What do you think? Cost to make it. There's some.
$1.
No, it can't be. If Macy's bought it for 50 cents, it's got to cost less than that to make it. The manufacturing process.
10 cent.
10 cent. Yeah, that's probably accurate. So that's probably, and these are real numbers. I'm not exaggerating. These are real numbers. So it cost the manufacturer about 10 cents to make that one red shirt. It's probably accurate. You know, because you got a lot of thread material, you know, the fabric. You got maybe a press for the logo, and very little bit labor. Okay, so about 10 cents roughly. That's direct materials, direct labor, factory overhead together to make the product. We'll say it's 10 cents total. Okay, so manufacturer makes the red T-shirt for 10 cents. They turn around and sell it to their distributor for, let's say, 20 cents. Okay? They sell it to their distributor for 20 cents. Macy's buys it from the distributor for 50 cents. Okay? The distributor also has cost. You know this, right? That you know, they have to ship it from Bangladesh to the United States. Okay, so there's expense there. So Macy's buying it 50 cents from the distributor. The distributor's cost manufacturing 10 cents. They buy it from manufacturer for 20 cents. To get the product from Bangladesh to the United States probably cost maybe another, say, 5 cents. So about 25 cents landed cost on the distributor side. Macy's buys the red shirt from the distributor for 50 cents. Puts it on the rack with a sticker that says $25. Okay? With me? So then the Macy's puts it on sale, $5 off. Dr. B comes in, buys it, $20. All right? So think about that next time you're at the store buying clothing. Any store, it's all the same. It doesn't matter if it's Macy's or someone else. They all use the same model. The worst offender is H&M. H&M and Forever 21. Those are the worst offenders of the group. Why? Because their practices are not good. Okay? That's a story for another day. So, the reality is, if Macy's puts that red T-shirt on the clearance rack and they sell it for $1, they are still making a profit. Never be fooled by the sign that says 90% off. They're still making profit. These are real numbers, my friends. This is how it works in real life. Okay. So, going back to the merchandise form here, we have net sales minus cost of goods sold. The cost of goods, so I bought it for $20. That's the net sale amount. Minus cost of goods sold. Macy's purchased that for 50 cents. equals gross profit. $20 minus 50 cents is $19.50 gross profit. Okay? Minus the expenses of the store. Store expense includes things like rent, utilities, wages, repairs and maintenance, etc. Okay, the list goes on and on. Then we get to net income. Net income off of that red shirt from Macy's that they have $19.50 gross profit. Net income is probably about maybe $2 after all the expenses. The retail business is very difficult with the expenses, yeah. But you see how that works. You see that flow of the cost, okay? So toward the bottom so now you know the formula to find net income for the merchandise business. Net sales minus cost of goods sold equals gross profit minus expenses equals net income. Okay, that's the formula. That's also the same way that your income statement is formatted for a retailer. Okay. Reason why cost of goods sold and gross profit are in the red at the bottom is to show you that's the difference between a retail business and a service business. A service business does not have cost of goods sold or gross profit. So interesting, right? Interesting. I had a feeling you'd be interested in all that because that's how real life works. That's how real life works. You know, when I first learned that, I was as blown away by it as you are. Okay, in retail, it's what we call a cyclical business. All right, it follows a cycle. We start with the purchase of inventory. In order for the business to sell things, they got to have things to sell, right? So Macy's goes and purchases their inventory from their vendors, their merchandise from their vendors. Okay, so they purchase the inventory from the vendors. Sometimes Macy's will either buy the merchandise in cash or on credit. What that means is when the retailer purchases inventory from their vendor on credit or on account, that means that we're creating an account receivable with that vendor. Or I'm sorry, account payable with that vendor. I'm going to pay that vendor later. Accounts payable. Okay. So I got my inventory now. Macy's we purchased our inventory from our vendor using either cash or accounts payable. Okay. Now I got my inventory. The next thing I'm going to do is sell my inventory. That's what retail is all about. I got to sell my inventory. So Macy's starts selling their stuff. You know, customers come in and they buy and they buy and they buy. Usually when a customer comes into the store, they usually pay in cash, okay, or a debit card or credit card or whatever. Okay, no problem. So they buy. Sometimes Macy's might have a large customer like, this is another real life example. Macy's might have a large customer like Marshalls or TJ Maxx. Okay, see where I'm going with this. Marshalls or TJ Maxx might approach a company like Macy's and say, hey, you know, I noticed you're not selling all that inventory all that fast. Why don't you sell it to us at a discount? You see? This is how retail works. How do you think Marshalls and TJ Maxx and Burlington and the other companies like them, how do you think they get their stuff? Sure, maybe some of it might be the same way that Macy's does it. But a lot of them, they buy them from places like Macy's that are having trouble selling it. So when that happens, let's say a larger customer of Macy's comes in, like TJ Maxx, and says, hey, I'll buy, 100,000 of those red shirts that you can't sell. All right. And we'll give you $8 per shirt. Okay. Macy's says that's a great deal. They're still making a huge profit, right? And then TJ Maxx turns around and sells the same red shirt for 20, 12. They're still making profit. When TJ Maxx purchases a rack of red shirts from Macy's, they usually do it on account. What they're saying is, hey, TJ Maxx is going to pay Macy's later on account. That's an account receivable for Macy's. Macy's is saying, yeah, pay me later. That's account receivable for Macy's. Okay. And then 30 days later, they collect from TJ Maxx. See how that works? And then they use that cash to then purchase more inventory. And then the cycle goes around again and again and again. It's continuous. Makes sense, right? But yeah, that's how it works. That's why when you go into a place like TJ Maxx or Home Goods or Burlington, and you're like, man, this is crazy. They got the same exact stuff that Macy's has. They're selling it for less. Yeah, it is the same stuff actually. So people don't know that. That's part of how it works. There's a couple of other avenues that they get their inventory, but you get my point. In talking about that inventory, there's a process. There's a process, and there's a way that they, when Macy's purchases the inventory, there's a way that they account for that. Okay, and we use an inventory system in order to account for it. Macy's uses what we call a perpetual inventory system. I'm going to show you what that looks like here in a second. But the way that we calculate how much merchandise Macy's has available for sale at any given time is we take the total purchases from our vendors plus the beginning inventory that we already had on the shelves. That equals the total merchandise available for sale. Okay. The other way I can figure out how much merchandise I have available for sale is I could take my cost of goods sold and add in my ending inventory. That'll also tell me my merchandise available for sale. You see, there's two ways to do it. So, as I said, Macy's uses what we call a perpetual inventory system. You ever think about how they know how much stuff is on the shelf? Like if I call up Macy's right now and I say, hey, I call up we'll say the Bethesda store or whatever. Say, hey, Macy's, how much inventory you got of this red shirt on the shelf? And they'll be able to tell me right away. Oh, Dr. B, we got 8 left. Okay, great. I'll be there tomorrow. Simple. Okay, how do they know that? They use what's called a perpetual inventory system. Think about how Macy's sells their products to their customers. It's simple. The customer goes into the store, they take the red shirt off the rack, they go to the cashier scans the barcode. The barcode represents the inventory. Okay, each line of product has a barcode. And that barcode is a unique identifier that tells Macy's, hey, this is a red shirt, this is how much we sell it for, this is how much it costs us to buy it for. Okay, shows us right there. So cashier scans the barcode. What's happening there is that as soon as that barcode is scanned, we're taking the red shirt out of our inventory and we're putting it aside. Okay, so it's no longer a part of our inventory. When I process the sale, the cashier processes the sale, it's out of our inventory. It now belongs to the customer. You see? It's a perpetual process. Every time the barcode gets scanned, it updates my inventory. So if I buy one shirt and then another shirt and another shirt, it's updating the totals of those shirts, of what's left. See? Perpetual, continuous. The other type of inventory system you should know about is called the periodic inventory system. This is where we do physical counts of inventory at the end of each accounting period. The type of business that would use the periodic inventory system is like a car dealership, okay, or a company that updates their stuff periodically, okay, like a car dealership or a specialty type store. What it means is that at the end of each month, the manager's going, okay, do I have this in stock? You know, they're physically looking at the inventory and they're physically updating their inventory. That's periodic. They do it once a month. That's the difference between the two. Technology makes the big difference, yeah. The barcode system. So now that you know a little bit about the type of inventory systems and a little bit about the cost process through my awesome Macy's example that you'll never forget, let's talk about a couple of transactions that we would see in a perpetual inventory system. So this one is very simple. Here I have a corner store that is purchasing $500 of merchandise from their vendor in cash. Simple. Call the vendor up, say, hey, I need $500 worth of this inventory. A few days later, they ship it to our store, and we pay them in cash. Yeah, same day. So I debit merchandise inventory to increase my inventory. Remember, inventory is a current asset account. Inventory is a current asset account on your balance sheet. Why? Because inventory is used to help the company to generate revenue by selling that inventory. You see? So inventory is a current asset on your balance sheet. So I debit merchandise inventory to increase my inventory. Anytime I debit an asset account, I increase that asset account, you see. And I credit cash to reduce my cash. Also an asset account. Sometimes, and I take advantage of this all the time actually, in retail, and sometimes in other forms. Sometimes you'll get a bill, okay? You'll get a bill, and it'll have what we call credit terms on it. Credit terms is an agreement between the buyer and the seller to encourage the buyer to pay early. Okay? Credit terms. Think about it this way. If I sell something on credit or on account to a customer, I want them to pay me early. I don't want to wait 30 days. Okay, I want the cash now or as quick as I can. So I'm going to encourage my customer to pay me early. I'll offer them credit terms. What that means is I'm offering a discount to my customer if they pay me early. Yeah, it's a way to improve your cash flow over time. That's why businesses do this. So the way it works is that on your bill, you're going to have on the invoice, we're going to have a couple of different things. We're going to see the invoice date, a discount period, a discount amount, and of course the total invoice price. You'll also see the date and amount due and credit terms, etc. All that information is going to be laid out on an invoice. And so basically what this is telling us is that if I pay this invoice early, I'm going to receive a discount. I'm not going to have to pay the full amount. Okay? So let me show you what common credit terms looks like. This is a common credit term. And here's how you would read this. We say 210 net 30. 210 net 30. Here's what this means. If I pay this bill within the first 10 days, I will receive a 2% discount. Otherwise, the entire bill is due within 30 days. Say it again. If I pay this bill within the first 10 days, I'll receive a 2% discount. Otherwise, the entire bill is due within 30 days. The 2 represents the percent discount. The 10 represents the number of days of the discount period. N represents the word net, or all. And 30 represents the credit period, the amount of time that the bill is due within. You see? These are what we call credit terms. This is the example of the invoice. I'd mentioned that you'll see a bunch of data on the invoice. Who it was sold to, where it's going, blah, blah, blah. You're going to see our company name. You're going to see the invoice number and the date. Invoice number and date, very, very important piece of information. As you know, in accounting, the date means a lot. It's almost everything, right? It's really important to know what the date is. Why? Because the date dictates when things are paid. Right? So in this case, we got November 2nd of 2021. We see the invoice number, who it was sold to, number 3, number 4, and this is also important, the purchase order date, when the order was placed. Number 5, very important, the credit terms, 2% discount in 10 days, otherwise all things due in 30. Number 6, the freight terms. Okay, the freight terms are also important because the freight terms tells us who is responsible for the inventory while it is in transit from the seller to the buyer. Say that again. The freight terms is important because it tells us who is responsible for the inventory while it is in transit from the seller to the buyer. There are typically 2 types of freight terms. One is called FOB destination, and the other one is FOB origin. FOB destination means free on board destination. That means the seller is responsible for the goods while it's in transit. If it's FOB origin or just origin, that means that the buyer is responsible while it's in transit. Responsibility usually means who's paying for the transportation of the product, of the inventory. That's what responsibility means. And also insurance. But we'll talk more about this here in a little bit. The 7th piece of information you'll see on an invoice is, of course, a listing of what's included, what was sold, product number, description, quantity, price, etc. And then, of course, we'll have the total amount plus any tax or shipping. And then you'll also see that net of discount. So this is easy to figure out. If you don't know what the discount amount is, all you got to do is look at the credit terms and the total. The total is $500. The credit terms are 2% discount if paid in the first 10 days. Otherwise, the whole thing is due in 30. 2% of $500 is $10. 2% of $500 is $10. So that means if I pay in the first 10 days, I'll be paying a total of $490. If I pay past the 10 days, my total is $500. See how that works? Let's roll through a couple of examples of how this would play out in real life. So here we have our corner store. I purchased my inventory for $500, as you know. And I purchased it this time on account. Okay? I'll pay my vendor later. And my vendor was kind enough to say, hey, Dr. B, if you pay me in that first 10 days, I'll give you 2% discount. Otherwise, the whole thing's due in 30. Okay, cool. So first thing I do is I recognize my inventory. I debit my inventory to increase my inventory, and I credit my accounts payable to increase my accounts payable. Remember, accounts payable, that is a current liability on your balance sheet. Liability means we owe something to someone else. Okay, so that's the transaction. The first option is that I'm going to take advantage of that discount. Okay, hey, anytime I can save $10, yes, I'm in. So I debit my account payable $500. You might be thinking, Dr. B, why are you debiting $500 and not $490? Because I need to reduce the whole amount, even though I'm going to pay a little bit less, you see? Otherwise, that $10 is just going to be sitting there, and I'm going to be like, why is it $10 in there? So you decrease by the whole amount, $500. And then I'm going to credit this account called merchandise inventory. But you already know what that is. It's your inventory account. I'm going to reduce the value of my inventory by $10. The reason why I reduce the value of my inventory by $10 is because I'm taking advantage of a discount. And I'm going to discount the value of my inventory because now technically my inventory is only worth $490 because I'm only going to pay $490. You see? So I credit merchandise inventory and I credit cash $490 to represent the discount. And that's the amount that I actually paid to my vendor, $490. What does it look like visually on the T accounts, you might be wondering? Okay, so here we have accounts payable, $500. I increased it by crediting it. I decreased it by debiting it. Remember, that's the way it normally works with a liability account. I got my inventory. I increased my inventory by $500. I decreased it by $10 to represent the discount of my inventory. And of course, I credit my cash to reduce my cash by the $490, the amount I actually paid. But that's what it looks like visually. Now, here's the other option. Let's say, I wish I could pay it in that 10 days, but I just don't have the funds to do it with. Okay, no problem. So I'll just pay the whole $500, just like I normally would. So I debit, accounts payable, credit cash. Simple. Once in a while, man, I hate talking about this part, especially this kind of gives me some PTSD from my years of working in retail. Once in a while, we would have what's called purchase allowances and purchase returns. Returns. Oh, there's that word. Oh, returns. Oh my God. Returns. Just saying it brings up terrible memories. Okay, so let's think about this. Purchase allowance. A purchase allowance is a purchase reduction to the buyer of defective or unacceptable merchandise. Here's what I mean. Once in a while, the merchandise may not look great. Some of it's damaged. Okay? Think about the corner store. I bought that merchandise for $500, right? And the vendor sends it to me. And I noticed the box, and I'm like, man, something's not right here. I open up the box, and some of this is damaged, or some of this is unacceptable. Right? It's just not in a good condition to sell. Like if let's say my corner store, $30 of some of the chewing gum that I ordered from my vendor is all messed up, like it's melted or the foil's all messed up on it or whatever, It happens. So I might call up that vendor and be like, hey, what's the deal? You sent me this box. Some of the gum's all messed up. The vendor will go, hey, no problem. We'll give you a credit on your bill, right? It's a purchase allowance. So I'm just going to take that part off of my bill. Right. Okay, thanks, no problem. Because they don't want it back. They don't want defective gum back. They say, hey, keep it. We'll just take it off your bill. Okay, no problem. Call that a purchase allowance. This other one is called purchase return. This is when merchandise is returned to the purchaser by the purchaser to the supplier. We're sending it back. We're returning it. Okay, purchase return. So I'm going to go through an example of each of you with our corner store. So here we go. The corner store, Z-Mart. We purchased $500 worth of stuff from our vendor, Trex. Some of the gum, the foil was all messed up. It was a little melted. So I'm like, I called them up and say, hey, I can't accept this. This isn't good. Vendor goes, hey, no problem. Just take a discount. So I need to record that discount. I need it off of my bill. So I debit accounts payable by $30. What that does is I'm reducing my bill to the vendor by $30 because the vendor said, hey, take $30 off your bill. Okay, no problem. Debit accounts payable, $30. And I'm also going to reduce my inventory by $30 because I'm not going to sell that defective gum. Okay, the wrappers are all screwed up. It's melted. I'm not going to sell that. So I got to take it out of inventory. So I credit merchandise inventory $30. So that's the adjustment I would make. Now let's talk about the other side of this coin. Now let's say, I make another purchase from my vendor. This time I'm purchasing $250 worth of stuff from my vendor. All right, and the vendor said, hey, you know what? If you pay that bill within the first 10 days, I'll give you a 2% discount. Otherwise, the entire bill is due within 60 days. Okay, that's a nice credit terms. So a few days later, I receive my merchandise and I'm looking through it. I'm like, you know what? Some of this ain't good. I can't accept this. So $50 worth of the $250 is no good. Okay, I received a couple of boxes of candies that were all melted. Like I'm not, I can't do this. Or maybe I ordered too much stuff. So I call up my vendors, hey, ordered too much stuff. I'm going to send this back to you, okay? So they said, yeah, no problem. Well, so we're going to send back $50 worth of our stuff, right? So in order to do that, I'm going to make the adjustment. debit the account payable to reduce the bill by 50, and credit merchandise to take it out of our inventory, right? So I sent back the $50 worth of stuff on June 3rd. Now here we are on June 11, and I still want to take advantage of the credit terms, the discount, okay? Oh, I still want to take advantage of the 2% discount. So I'm going to do that. But I'm only going to do that on the remaining balance of the inventory. I can't take it off the whole $250 because I sent back $50 worth of stuff. So I'm going to take the discount off of $200. So I debit the remaining account payable, $200. I'm going to credit merchandise inventory by $4 to reduce the value of the inventory by $4. Why $4? Because the 210 net 60, 2% discount if paid within the first 10 days. 2% of 200 is $4. Okay, so merchandise inventory credit, $4. And I'm going to actually pay my vendor $196 cash. Yep. That's how that works. So, yeah, you can see why I don't like returns all that often. It's a lot involved. Okay. Earlier I mentioned about the shipping. Why is shipping so important? It tells you who's responsible for the shipping. Okay, two types of shipping: free on board destination and free on board origin or shipping point. Okay, so let's start with shipping point. The transfer of ownership is at the shipping point, free on board shipping point or origin. What this means is that the buyer of the inventory is responsible for the inventory while it's in transit. What that means is that the buyer is ultimately responsible for the cost of shipping. So the buyer would debit merchandise inventory to increase the cost of the inventory by the amount of the shipping amount, and credit cash to pay the shipping expense. Now, if the seller is responsible for the goods while it's in transit, we call that free on board destination. That means the seller is responsible while the inventory is being shipped from the seller to the buyer. Okay, the seller pays for the shipping. So the seller would debit delivery expense and credit cash to pay for the shipping. Very straightforward. Makes sense, right? Now, here's the difference. Here's the big difference. The buyer, when the buyer pays for it, you'll notice that they add that cost into the total cost of their inventory. You might wonder why that is. The reason why the buyer adds the total cost in the inventory is because the total cost of inventory is not just the purchase price of the inventory. It's the purchase price plus insurance while it's in transit, plus the cost of getting it shipped, plus other costs, right? Those are the total costs of the inventory. So transportation costs, how do we record them? Here we have our business, the corner store. We purchased merchandise. The term was free on board shipping point, which means we are responsible for the transportation charge of $75. I'm going to increase the overall cost of my inventory by $75. And the way I do that is I debit merchandise inventory and credit cash to pay for the shipping. Here we have a short report on what we call itemized costs of purchases. What this is it shows you all the purchases you made for your inventory. In a very sensible way, we add up all our purchases, minus any discounts that we received on our purchases, plus any return allowances, oh, I'm sorry, minus any returns that we had to make. And then we add in the cost of transportation to get the total cost of our inventory. So it's the inventory purchase price minus discounts that we received, minus any returns or allowances we made, plus any cost of transportation, equals the total cost of our inventory. Okay. All right. We're almost done. So using our perpetual inventory system, we can also analyze our gross profit. Gross profit is calculated by taking your net sales minus cost of goods sold. So sales minus cost of goods sold equals gross profit. Okay? Remember, cost of goods sold, that's the total cost of the inventory that we sold to our customers. Total cost of goods sold. That's where the name comes from. Net sales. Net sales are our gross sales, total sales, minus any discounts, returns, or allowances. Gross sales minus any discounts, returns, or allowances we made to our customer. Sales minus any gross discounts, returns, or allowances. So net sales is net. It's the bottom number. Gross sales minus discounts, returns, and allowances equals net sales. So net sales minus cost of goods sold equals gross profit. Just remember that formula. When we sell inventory, there are actually two transactions that occur. The first transaction is that we need to recognize the sale itself. Okay? Remember, in business, it's important to sell your inventory above its cost. Otherwise, you're going to go out of business, right? We go in business to make money, to earn revenue. Okay? Your sale price should always be above your cost. Simple. Hopefully I don't have to tell you that, but your sale price should always be above your cost, right? So that's going to be two different amounts. If I purchase my inventory for $300, I'm going to sell it for $1,000. That makes sense because I need to make a profit, right? I need to make a profit. If I purchased my inventory for $300, I'm going to sell it for $1,000. That's going to get me a gross profit of $700. See, sale price $1,000 minus cost of goods sold $300 equals gross profit $700.
Excuse me, Professor.
Yes, please.
Does it have to be that significant, or does it depend on what the merchandise is?
Depends on what it is. And it depends on who's selling it. So Tanika, earlier I gave the example of the Macy's example, right? The red T-shirt. Their profit margins are huge based off of this calculation, right? Clothing typically has about a 900% markup. Okay. Furniture typically has about a 700% markup. Electronics, the markup's not that big. It's maybe like 50, 60%. It depends on what it is, the product that you're selling, and it also depends on who's selling it, right? That's what determines the sale price typically. And the free market, of course, supply and demand. That's what really sets the price. But so to answer your question, it depends on the retailer. So in my example, I'm going to sell my inventory at $1,000. It cost me $300 to buy. That means I'm going to have a gross profit of $700. Sale price minus cost of goods sold equals gross profit. So there's two types of transactions that occur. The first is I recognize the sale, the $1,000. I'm going to debit my accounts receivable or cash, depending on how I'm receiving the payment from the customer. And I'm going to credit sales, the $1,000, because I sold $1,000 worth, right? That's the first transaction. The other transaction we need to make is to recognize the cost of goods sold, to recognize that we sold the inventory. So I'm going to debit cost of goods sold, $300, and credit merchandise revenue, $300. Merchandise inventory, $300. So that's why we say that there's two parts involved. This is what that transaction looks like. I've recognized my sale first, debit accounts receivable or cash, credit sales. Then I recognize that I sold inventory. I debit cost of goods sold and credit inventory. What that does is it takes it out of inventory, right? So we do these two transactions for every sale that we make. Now, in real life, it's automatic, but it just kind of shows you how it works in real life. Yeah. So now, we sold the inventory for $1,000. We purchased it for $300. That gives me a gross profit of $700. Sales minus cost of goods sold equals gross profit. Let's throw in a couple discounts, okay? So sometimes we know that there might be a discount. Customer says they'll pay me early, so I'll give them a discount. Pay me within the first 10 days, I'll give you 2% discount. 210 net 30, net 60 or whatever. Credit terms. I could do that for sales. I could do that for purchases as well. We negotiate all the time in business. So here we go. I sold the $1,000 on accounts receivable this time, right? Accounts receivable. So I debit accounts receivable, credit sales. I recognize that sale by debiting cost of goods sold and crediting merchandise revenue. Merchandise inventory by the $300. We sold it to our customer on account. And we said, hey, customer, you pay me the first 10 days, I'll give you 2% discount. Otherwise, the whole thing's due in 45 days. Those are the credit terms. Customer agrees. If the customer pays us during the credit terms, the first 10 days, they receive a 2% discount on the $1,000, okay? So here we have November 22nd. The customer is paying us within the discount period. Awesome. They're going to give us $980 in cash. That's because they received a 2% discount off of $1,000. 2% of $1,000 is $20. So the discount amount is 20. So I received the cash from the customer of $980. I debit cash $980. There was a discount. I debit sales discounts $20. What that does is I'm actually reducing my sales amount by debiting it. Because remember, sales revenue, that's an equity account, right? Sales minus expenses equals net income. That's all equity. So I'm increasing my cash asset account. I'm lowering my equity by the $20. And I'm lowering my asset accounts receivable, 1,000. See, the accounting equation still balances out. That's what I'm trying to say. So debit cash, $980. Debit your sales discounts, $20. and credit accounts receivable 1,000. That's if they pay within the discount period. If the customer decides to pay after the discount period has already passed, then it's a very simple transaction. Debit cash 1,000, credit accounts receivable 1,000. What about sales returns and allowances? Sometimes our customers will return stuff, or sometimes they'll receive stuff that's damaged or stuff that they don't want or whatever. Okay, that happens, unfortunately. Customers can be dissatisfied. In order to satisfy our customers, we will offer them the opportunity to return the goods, or we'll offer them a discount or an allowance, right, on their account. So these things happen, just like they happen on the vendor side of the business. Okay, so a couple of examples with this. Here we have a sale with return and allowance. The customer is returning merchandise that they purchased from us, which was sold at $15 and it cost $9. Nothing wrong with it. It's not defective. The customer just decided they don't want it no more. Okay, no problem. We'll take care of you. We'll give you your money back. So in order to give the money back, we debit sales returns and allowances. It's an allowance account. Temporary account shows up on the income statement. And we credit cash to give them the $12 back. The $15 back. But that also means I got to put my inventory back on my shelf. There's nothing wrong with it. So I'm going to debit merchandise inventory, $9. Credit cost of goods sold to reduce cost of goods sold, $9.
If you're selling food, though,
Oh, that's a whole nother ball game.
You can't do that, right? Because you can't get the merchandise back.
Right,
At
exactly.
McDonald's, they like you could just keep the burger. Like they can't put that inventory back.
They keep the burger. That's right. Yeah, they ain't gonna put food back. Yeah, it depends, Danica. So sometimes, like you said, if it's food, they ain't gonna put it back. All right. Like the grocery store, maybe, probably not. They probably won't put back produce, but they will put back, dry goods like chips and whatever's that are prepackaged. They'll put that back, no problem. But they ain't gonna put back no produce. All right, they just say, yeah, keep that. We'll give you your money back anyway. Or what, Tanika, what a lot of businesses, what a lot of businesses in that type of position would do, like let's say it's a food truck. Okay, you go to a food truck. Food truck ain't gonna give you no refund. They say no refunds. So there's ways, right? Yeah, good. That's a good conversation.
That's true. That's true.
Right. It depends on the business's policies. That's why you got to read that's why on the back of the receipt, it says what the store policy is for returns and allowances. Good point. Okay, so here we have another example. Let's assume that $40 of the merchandise that we, our corner store, sold to our customer is defective. But the buyer decides that, hey, you know what? Why don't you just take the $10 off my bill that I owe you in 45 days from now? Okay, no problem. So we debit sales returns allowances $10. Credit account receivable $10 to reduce the customer's account receivable to us by $10. Yeah, it's normal day-to-day business operation. As I had mentioned, those allowance accounts, they're temporary accounts. So as you know, what we talked about last week when we talked about the accounting cycle is that we got to close out. We got to close out our temporary accounts. You know this. So just like in any other business, we got to close out our temporary accounts. This represents the physical flow of the accounting cycle, right? So we got our purchases plus beginning inventory equals merchandise available for sale. Also, to find merchandise available for sale, we take cost of goods sold plus the ending inventory. Ending inventory ends up on our balance sheet. The ending inventory from last month becomes the beginning inventory for next month, or for this month, plus purchases equals merchandise available for sale. You see, it goes on and on and on. It's every month. Every month we need to make the adjustments at the end of each month, as you know. Now, we make also adjustments in retail for other things. As you know, in retail, the business is never perfect. We make mistakes just like anyone else does. So when that happens, we need to make adjustments. We also have situations where inventory goes missing, okay, for whatever reason. Maybe it fell off the shelf and broke, or a customer decided to take it instead of paying for it. Okay, it happens, right? Either way, we have to reflect that loss of the inventory. Inventory fell off the shelf and broke, or someone stole it. But either way, the company has to account for that loss. So we debit cost of goods sold to recognize the increase of the cost of goods sold, and we credit inventory to reduce the inventory. This is an adjusting entry that we make for any type of loss of inventory. When we close out our temporary accounts, as you know, we debit our sales and credit income summary. We debit income summary and credit all of our expenses. I had mentioned that sales discounts, returns, and allowances, those are all, and cost of goods sold, are all temporary accounts. What makes it a temporary account is that it shows up on our income statement. If it's on our income statement, it's a temporary account. We need to close those out through the normal closing process. Debit sales, credit income summary, that closes out all of our sales. Debit income summary, credit all of our expenses, that closes out all of our expenses. We close those out to our equity account. Debit income summary, credit paid in capital, minus any withdrawals. That's the process. You know the process. We've gone through this a couple times. We're just adding in a few different accounts that we didn't talk about before, but they're all temporary. They're all in the income statement. This slide is nice. It's just a summary slide, and it shows you like the transactions. This will come in handy for your quiz. So just think about that. Summary slides. Summary slides are nice. This is the last summary slide that we'd make, yeah? Just kind of shows you the process in a nice summary. Okay, last part is the income statement. As you know, with the income statement, it can be displayed in two different ways. One is called the multi-step, the other is called the single step. In a multi-step income statement, we're simply breaking things out by the order of which they're grouped together. What we mean by that is that we're separating it out by gross profit in retail. We have sales minus discounts minus cost of goods sold equals gross profit, minus all your expenses equals total operating expenses. It gives us income from operations. Plus or minus all the other random stuff that happens like taxes and interest, etc., equals net income. But you see how it's all grouped together. We call that a multi-step because there's multiple steps in the format. That's in comparison to a single step format, which is just revenue minus expenses equals net income. That's a single step, right? There's no steps involved. It's just the one process. On the balance sheet for a retailer, the only difference, of course, is going to be inventory. Now we have inventory, whereas a business that is a service business does not have inventory. And the last thing to talk about, and I can't let you go without at least one ratio. You know that. This is accounting. We do ratios. We have what's called the acid test ratio. The acid test ratio is commonly used in order to determine the retailer's ability to pay its current liabilities. Okay, how liquid is the business? Okay, and to do that, we take quick assets divided by current liabilities. Quick assets are assets that I can quickly convert into cash. And those include things like cash, short-term investments, and receivables. Cash plus short-term investments plus receivables are known as what we call quick assets. Divide that by current liabilities, and that gives us our acid test ratio. And this is an example of the acid test ratio. The last ratio, I think, for today is called the gross margin ratio. This is really important because it tells you how much profit we expect from each sales dollar. We take sales minus cost of goods sold divided by sales. That gives us our gross margin ratio, percentage that we expect in profit from each sales dollar. And this just shows you a comparison of the periodic and the perpetual inventory system side by side. Nice summary slides here. Summary slides. Some more summary slides. Examples of other adjusting entries. Nothing to get too excited about. More adjusting entries that we would make for things like sales refunds. Just, we've gone through all this already. This is just more summary stuff. Again, perpetual inventory versus periodic. And that brings us to the end of the chapter. There's a lot of the summary slides in this one. Okay, so as a reminder for this week, we have our week 5 discussion board. There are 9 questions for you to answer here. Please answer all 9 of them. Just 1 sentence per question will do it. Okay? Be precise, be concise. 9 sentences, 1 sentence per question. We'll answer this discussion forum. Please do that by Thursday night and respond to 2 of your classmates by Sunday night. And that will be good discussion. And then you have your Chapter 5 quiz related to what we just talked about. Are there any comments, questions, or concerns that I can help to address at this time? Good. We get. All right.
I have one question, but after class.
Okay, sounds good. Okay, so in that case, thank you all so much for your time today. I sincerely appreciate all of you and all of your efforts that you're making in the class so far. If you ever need help, you can email me, call me, set up office hours. I'm here for you all the time. And I do mean that. Even though for the next 3 weeks I will be in Medellin, Colombia, I will still be reachable by email. And of course, send me a message through the classroom. All right, I'll be there. Thank you all so much for your time. I appreciate all of you. Have a wonderful rest of your night. Appreciate you.
You too. Thank you.
Take care.
Thank you so much, Dr. B. Enjoy
Thank you.
Columbia. Be
Oh,
safe.
I will do my best. Thank you so much. I'm there for work, so
I know, right?
But thank you. I appreciate that.
Thanks. Have a good evening.
Thanks. Good night. Appreciate you.